Hey everyone, Daniel Snyder here. Thanks for taking the time to tune into this webinar. Today we have Avi Gilbert. He is the investing group leader over at the Market Pinball Wizard. He is here to break down the markets, which we know there is tons of uncertainty, whether you're focused on tariffs, whether you're focused on the dollar, whatever it is, right? Watching your earnings, watching your portfolio. Well, we think you're going to love this one today. But before we dive into conversation with him, let's go ahead and get a quick legal disclaimer out of the way. Past performance is no guarantee of future results. Any views or opinions expressed in the webinar do not reflect those of Seeking Alpha as a whole. Seeking Alpha does not take account of your objectives or your financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed security dealer, broker, or U.S. investment advisor or investment bank. Information provided by the investing group does not constitute investing advice. Investing group leaders are third-party authors that include both professional investors and individual investors who may not be licensed or certified by any regulatory body. Any content and tools on the platform are offered for information purposes that only. And now, with that out of the way, we're going to get into charts here in a little bit. But first things first, I want to introduce everyone to Avi Gilbert. If you don't know who he is, Avi, thank you for jumping on here. Maybe for those attending right now that aren't aware of who you are, maybe you could give us a little bit of background of where you started, how you got into financial markets, and where we got to today.
Well, the way I got into it was not the best of stories. I'm both a tax attorney and a CPA by background. I was a partner, national director at a major firm when I had to leave and raise my children as a single father. I remarried not too long after that, and my second wife came down with a very serious and rare form of cancer after we had our last child together. And while I was in the hospitals with her, I started day trading out of her hospital room. And I joined a site of a gentleman named Harry Boxer many moons ago. And, he would announce the stocks that were gapping up. And, I'd trade along with everybody else. I started feeling a little more comfortable in the room. And so I started making market calls and stock calls and started developing a following in his site. So Harry gets on the phone with me one day after he's watching this for a while, and he asked me what I'm doing. So I explained to him the methodology that I'm using, and he said, "Well, I'm going to watch you." So a few months goes by. He calls me back again, and he says, "You know what? You're really good at this. You should start teaching people what you're doing." So I explained to him, I have an infant at home. I have 3 other kids at home. I have a wife who's ill, and I can't start anything new. So this went on for a little longer, and then ultimately we started seeing some daylight in my wife's condition, and she started pushing me to do it, and Harry was pushing me to do it. So ultimately it pushed me into starting to write publicly and opening up our first platform, Elliot Wave Trader. And now, we have the platform there. We have the platform on Seeking Alpha. We have almost 9,000 subscribers, or somewhere around 1,000 money manager clients, and we're 13 years after that. So that's the story of how I got into this.
It's quite the journey. And I already see people jumping in here in the chat wanting to know where the market's going up. Next, up 5% or down. What are we going to find out? Well, we're going to find out here and find out with the charts here in just a little bit. But before we jump into that, let's lay the stage for the people that don't know what Elliott wave theory is. Could you give us the overview?
Well, most people will follow the market based upon a perspective of fundamentals or economics, all the different things that everybody follows out there, all the various reports. Back in the 30s, Ralph Nelson Elliott, back in the 20s, actually, Ralph Nelson Elliott identified a methodology wherein he recognized that the market was fractal in nature, meaning it was self-similar at all different degrees of trend. And he broke it down into identifying that there were 5 waves within a trend, 3 waves moving with the trend and 2 waves counter trend. And he also identified that a lot of these turning points in each of those segments of those 5 waves will turn at Fibonacci ratios. So, as I say, we stand on the shoulders of giants in being able to identify these market turns based upon, Mr. Fibonacci himself, or who is Mr. Bagolo was actually his real name back in the, I think it was the 1100s, I believe, that he identified the Fibonacci ratios, and then on the shoulders of Ralph Nelson Elliott. And so we have built a more objective framework around the Elliott wave standard analysis methodology that we call Fibonacci pinball. And it tells us in a much more objective fashion, how the market's going to move. And it tells us early when and if we are wrong in our expectations. So that's generally what we do in a nutshell.
So you've got the Elliott wave theory that you're using kind of as the map to navigate the waters of the market, right? And this does it work for all asset classes?
It's an interesting question you asked. The answer is yes, but we have to recognize that the methodology is based upon mass sentiment being displayed in the stock market. So if you have something, whether it's a stock or whether it's an index that displays mass sentiment, then it works extremely well. I say you have to look at it based upon a continuum. On the left side of the continuum, you'll have a micro cap biotech stock with one product in its development. And you're not going to have a lot of mass sentiment being displayed around trading that stock. With that stock, you're really going to have to know the fundamentals of that product as to whether or not it's going to come to fruition and so on and so forth. So mass sentiment is really not going to help you. Elliott wave theory is not going to help you with a small stock like that. However, on the other side of this line, you have stocks like Google, Meta, the mega caps, and they clearly display mass sentiment in their buying and selling. And Elliott wave theory helps tremendously with those type of stocks. So am I going to say that we're going to be 100% accurate? No, that's an impossibility. We're human. However, people have tracked us at being between 70 and 80% accurate in our analysis.
So when it comes to mass sentiment, is it, if the stock is in the S&P 500, is there a certain market cap level? Like, how should somebody know if what they're looking at falls within that category?
Generally, if it's an S&P 500 stock, you're dealing with mass sentiment.
But so S&P 500, you got mass sentiment. What about commodities or currencies? How do you approach those?
Absolutely. Absolutely. I would say most commodities, you can apply Elliott wave analysis to quite successfully. Currencies, absolutely. I mean, I'll show you. We're going to look at a monthly chart of the dollar at the end of this, and you'll see how well this thing has adhered to the Elliott wave form. Well, literally for decades.
Yeah, and I know somebody's going to yell at me if I don't ask you this, but crypto, does it work for crypto as well?
Oh my God, it works for crypto so well. I mean, I spoke at a conference not too long ago, and I said to the conference, and this is during the time when crypto was on a tear, and I said, you know what? When we approach 100,000 on Bitcoin, I'm selling. I've had a very large position I've had since maybe, I've been in and out several times. I think the last time I got back in was around 20,000. And I said, I'm selling my entire position once we reach 100. I still expect it to reach 125, but I just have a perspective that I like to sell at the top of the third waves. And then if I want to, I can always buy back after the fourth wave pullback. Well, so yes, we got the top of that third. We are now trying to finish off that fourth, and we still expect one more higher high, probably about 125, 135, somewhere around there. And then we expect a very long bear market. So it works exceptionally well. But when I spoke at that conference, people were literally laughing at me when I told them I'm going to sell my crypto. Literally, they were laughing at me because it was just on a tear. I'm like, it's going to keep going, of course, they said. Well, not really.
So I'm sure some people watching right now might not be able to visualize what these waves look like, where the pullbacks, the Fibonacci retracement. So I would like to go ahead and start diving into the charts, if you don't mind, and get past us. So let me go ahead and pull it up here on my screen. We'll just go into the full screen mode as well. So we are starting with the SPX index on the monthly chart. You want to walk us through what we're looking at here?
Absolutely. Now, we are, it's kind of cut off, but if you see the Roman numeral 3 in paren at the top of the chart, That is the end of remember I said Elliot gave us a 5-wave structure in the market. That top is the end of a 3rd wave, the 2nd wave of which bottomed in 1932, I believe, after the 1929 market crash found a bottom. So yes, we are dealing with almost a 100-year 3rd wave trend that is coming to a conclusion. Have we actually topped already? Maybe. I'm not so certain about that yet. But we are very close from a relative perspective. And my expectation is in the bigger time frame, once we complete this final move higher, my expectation is we should be moving into, the best case scenario is an 8-year bear market, but I think it's more likely going to be probably closer to 15 to 21 years is my expectation.
Okay, so just trying to see what we look at here. Actually, I'm going to see if I can grab the annotation here. So we're looking back here. Let me know if you see that or not.
Yep.
From 2009. So we're looking at 2009. You got this big old, is this the fourth
Yep.
wave that you're talking about? So now we're approaching this 5th up here at
It's a 5th of a 5th of 3. Yes. Now that 4th wave actually started in 2000. The high of the 2000 market was actually the high of that Roman numeral 3. And the drop into 2002 or 2003 was the A wave. We then rallied back to 2007 in a B wave. And then we got the crash in the C wave of that wave 4. The corrective structures take shape in 3-wave structures. We label them as ABC. And and that's usually waves 2 and 4. And waves 1, 3, and 5 take shape, break down into 5-wave structures themselves. So that's why you see an ABC on that Roman numeral 4 at the bottom. And we are now finishing off the COVID crash low was the bottom of the 4th wave of this 5th wave. And now we're trying to complete a final 5th wave.
Right. So I just drew here on the screen as well. That is the COVID low. So you're saying
Yep.
This is the 3rd wave here, a 4th wave pullback, and now this is the
Yep.
5th extension going up. Okay. So from here, for people looking at this, is it as simple as now we're expecting the pullback like this, that you kind of have this ABC here?
Yep.
All right. And then
now, mind you, because corrective structures are much more variable than the 5-wave structures, this is a general path that I am providing. 4th waves are the most variable within the Elliott wave structure. And B waves within corrective structures are even more variable. So whereas I'm just giving you a general path of my expectations, while we go through this, it's going to be a process of tracking each and every subwave to make sure that the full wave is appropriately developing. So, like I said, this is a general path expectation, but the real form as we take shape over the coming decade or two will probably look a little different.
Gotcha. So these do adjust over time depending on the price action of what's going on in the market.
Absolutely. We do not remain married to anything. What we may remain married to is just the truth. That's all we want to know. What is the market telling us? This is a general path that 4th waves usually take. However, we listen very closely to the messages the market gives us, and that's what we follow. So we adjust as need be, especially during corrective structures.
Copy that. All right. So you want to go a little bit deeper in the time series here?
Absolutely.
Going in here, I think we have the daily next. There it is.
So now the daily is really a factor of trying to determine, have we struck our top? Now, normally, I will tell you, normally, it is not as difficult as this chart represents. Normally, we complete a standard 5-wave Elliott wave structure into a high, and that tells us we are likely about to turn. And the 5-wave structure breaks down into a standard Fibonacci pinball structure that is relatively easy to follow. Unfortunately, the wave, which began back in October of 2022, has taken shape with 3-wave substructures rather than 5-wave structures. So it tells us that we are dealing with what Elliot called an ending diagonal. And what makes it even more difficult is that we're dealing with a very extended 5th wave in it, but it is an ending diagonal which does not necessarily look complete. Can I provide for you a count that has the top already in place, in the highs we were striking a few months ago? The answer is yes. And that's what the alternative red 5 is there for. However, I'm not wholly certain about that. Now, mind you, I raised probably about 50% cash in all my equity holdings at that time, and I'm looking to deploy some of that now as well. But my feeling is that we probably have still one more rally yet to come. So I'm not definitively in the large bear market has begun yet, but we are tracking this very, very carefully, and we're playing the final wave very cautiously, shall we say, because I believe if we're going to get one more rally, whether it be the rally addressed by the green structure or the yellow structure, one more rally is not necessarily guaranteed, which is why we're playing it a lot more cautiously. I remember when I wrote an article, I don't know if you were able to include this, but you could show the chart that I sent you, the last one, to ask you to include it. Back in November, I wrote an article that included, yes, this is the chart, I believe. No, this is a chart from December, but I wrote an article basically discussing what I'm seeing based upon this chart. And my expectation was that there is potential this could be all of the high we see that we're coming into. And at the time, if you remember, people were pounding the table. Market's going to 7,000 in 2025. Like, okay, you can have it your way, but the structure is telling me we're going to be pulling back to at least that blue box target that I had on there. It took a little longer than I expected, of course, but we're there. The market is there now, and we've now pulled back exactly where we expected to. So, the market is going to be very, very treacherous. However you look at this market, it will remain treacherous for several months to come until it is going to resolve whether or not it's going to try to make one more higher high or not, or if it's going to start telling us that the long-term bear market has indeed begun. So this our chart is just telling you, when you start hearing people banging on the table about how certain they are about something, it's usually the time when the market is about to turn. And that was pretty clear to me as we were going through November and December.
Yeah, so just to make sure everybody's clear on this chart is from December. So as of right now, we are actually down in this alt 4, correct?
Yep.
Bouncing around in the alt 4 right here. And
I've made that my primary for now. That's going to be my primary as long as we hold the 5490, 5495 region. Now you can see a spike of that support and then rally back up through it. But as long as we don't see a sustained break of 5495, we can begin a rally to higher highs sooner rather than later. If we break down and see a sustained breakdown of 5495, that is a big warning that the all-time high may be in place. I'm going to give the market one more opportunity. If you can go back to the daily chart, I'm going to give the market one more opportunity after that and for the yellow count that I have on the daily chart, where we just go back down towards the 5,000 region or so, somewhere between 5,000 to 5,400. And if we were able to begin an appropriate type of rally from there, maybe we could still get one more higher high. But this market is a very tired market, whether you're looking at it from a period of 2 years, whether you're looking at it a period of 10 years, whether you're looking at it from the 100-year perspective. We are coming to an end of a major, major market rally that began in 1932.
So question here, you have some commentary on this chart actually around the Fed. Does the Fed go into a lot of what happens with your outlook here on the charts?
Well, the commentary that I have on here is actually making fun of all the people who follow the Fed for what the market's going to do. Although quite often we see the market do the exact opposite that most people believe that it's going to do based upon the Fed. For example, as the Fed was raising rates higher and higher and higher, everybody was throwing their hands up and saying the market's done, the market's done. There's no way the market can rally with the Fed raising rates into it. Meanwhile, if you look at the notes, the Fed continued to raise rates, yet the market continued higher. Rates themselves were going higher, yet the market was going higher. So people try to correlate rates with what the market is going to do. Unfortunately, it really is not the right way to be playing the market.
Interesting. Now, also down here at the bottom, you have the momentum, the MACD indicator.
Yes. Yes.
You got squares and circles. What are we looking at here? How does this correlate to the chart?
Well, the squares and the circles are general support areas we track. And as you can see, the current decline has broken the standard support that I normally like to see, which is why this is making me be a little bit more cautious. Now, we are so oversold, we're as oversold on the MACD on this daily chart relative to where we were in 2022. But, it's a bit of a, in 2022, it represented the lows. It could still represent the lows, but because we broke the standard support that we were seeing during this entire rally, it suggests a little bit more caution.
Interesting. Yeah, thanks for clarifying on that. So let's jump over. I know you wanted to talk about gold. Let's look at gold here on the daily. So we've got what looks like, is this wave 3 or where are we at here?
Okay, so to give you a little context, back in 2011, we called the top in gold within $6 of the high while it was going through that parabolic rally. That's when I started writing publicly, actually, which is pretty funny. It was one of my first articles, public articles, the public market calls, that I actually made a call for gold. And it was during the parabolic rally during that summer. I think I published it in July or August of 2011. And everybody at the time, because it was involved in a parabolic rally, everybody at the time was arguing only about one thing. How far past 2000 was gold going to rally during that time? And I put out this article and I said, gold's going to top my target was 1915. And then I thought it was going to go into a very long, the potential was it was going to go into a multi-year correction. And when that article came out, it was my first article on Seeking Alpha that actually presented a market prediction. And I got to tell you, for my next couple of articles on gold, I was reamed by the public. You know nothing about gold. I mean, I was reamed. But gold topped at 1921. And as we know, it went all the way back to 1,050. In fact, I think in my second article, somebody actually asked me, if gold does top and goes down the way you expect it, what's the target that you have for gold? So I said, well, my ideal target is somewhere around 1,000. And when I said that, oh my God, I was reamed twice as badly because gold was still going through that parabolic rally. And I was saying we're going to go down to 1,000, and people thought I was absolutely nuts. Well, now we know that gold came down to about 1,050. And literally the night that gold bottomed, we actually called it right then and there that I believe this is finally ending the multi-year correction, and I'm expecting a multi-year rally in gold. Now, from that rally in gold, we are now completing the final stages of that rally. And this is the final fifth wave in that five-wave structure off the low, which was struck at the end of 2015 in gold. It was either the last day of 2015 or the first day of 2016. I don't remember exactly, but it was around that time that gold bottomed in 2015, 2016. And we are now coming to the end of a five-wave structure off of that low. Now, my expectation is that we still have one more 4-5 to go before it's done. But, as more and more people are going to be getting very bullish metals, and I think we're going to see the action in that final fifth wave, which probably will look parabolic. And that target I have up there is rather conservative. It could easily exceed that. But I think we're probably going to see one more parabolic rally in gold and a much stronger rally in the mining stocks and silver before this is done and we go into another multi-year correction in gold and the other metals.
Yeah, so you mentioned silver. So I want to jump over to this chart here. Now, the 144-minute time frame might be a little weird to some people. Why specifically 144 minutes?
Well, two reasons. One, it's a Fibonacci time frame. And two, I don't know why. I don't know why this is the case, but over all the years that I've been doing analysis for decades now. I've only been doing it publicly for 13 to 14 years, but I've been doing analysis for decades. But for some reason, the MACD on the 144-minute chart gives us some of the clearest turning signals I've seen. And this is only in gold, I'm saying silver, believe it or not. I've tried to replicate this in other products as well. Silver, for some reason, the 144 MACD is just, sorry for the pun, gold when it comes to identifying the turning points in silver. So that's why I have a 144-minute chart that I follow quite often. What this chart is showing me is I have a pivot overhead. Should we be able to take out this pivot, you can set your stops just below the pivot. And my expectation is we should be running well into the 40s based upon the current setup. Now, of course, we continue to track it on the smaller degree charts as well, just to make sure that, everything we're doing stays within the parameters that we want to see. Otherwise, we'll stop out and just make sure we grab our profits before they whittle away. So, but that's what I'm looking for. The setup right now is such that we could be setting up. Could we get one more bigger pullback before then? Sure. But once we take out that pivot, we're going to be moving our stops up and allowing it to run.
Now, when it comes to when you draw the circles and squares here on the chart, mainly the circles, right? When you're talking about the leg three or the wave 5 of the leg 3, I think I'm saying that correctly. Correct me if I'm wrong, please, because I'm not this detailed in Elliot. But people might be looking down and look at the time frame on the x-axis. Does the time frame can shift, right? Like
excellent point.
46 at April 21st.
Excellent point. What Elliott wave analysis allows us to do is identify some very accurate targeting, but it does not provide for timing. I have done more research on trying to identifying a timing trigger than I can even tell you. I have been in search of one for decades. The best I have ever seen does not even get beyond 50%. So, whereas Elliott gives you phenomenal targeting when it comes to pricing, I have not found anything yet that has been able to provide timing. So when you see my numbers and where they are, do not, and that's a great point you just made, Daniel, thank you. Do not assume that that's when it's going to hit. It is just for representative purposes to show you the path, the general path.
I'm glad we cleared that up. So now I want to move into your last one that you kind of teased about earlier, because I know a lot of investors watch, what is happening with the U.S. dollar. People, we know the administration is focused on it. They want a strong dollar. When, U.S. companies are selling products to the rest of the world, it obviously matters with the trade balances. So let's jump over here to the U.S. dollar. Why don't you go ahead? I mean, this show looks very bullish to me. So can you just kind of break us down? I mean, a 125 on the dollar, is that right?
Yeah, I mean, that's generally my next bigger target. It's interesting. If you go back and look to the left bottom, the market, the dollar bottomed, at least Dixie bottomed around the 2008, during the 2008 market crash. And as we were developing that bigger bottoming structure that I have labeled as the 1-2 down there, if for those of you that may or may not remember, what was the big discussion at the time? The big discussion at the time was how quantitative easing is going to kill the dollar. That was the big discussion. And I remember, I'm looking at this chart and I said, you know what? I see a multi-year rally. My first target was that what was that number? The 103.31 number. That was my first target. So if you look at the top of 5 of 3, Roman numeral 5 of 3 back in 2010, 11, if you look at it over there, that was my first target off the bottom of 2, the 103 right there, 103.31. So as we were down in 2011, I actually put out a market call, probably one of my second big market calls, looking for a rally from the 70s in the dollar all the way up to 103.31 was my target. And yes, because of quantitative easing at the time, I was ripped to shreds. Absolutely. You don't know what you're talking about. Quantitative easing is going to cause the dollar to tank. I'm looking at this chart and I'm saying, nope, dollar's going to 103.31 next in a big way before I expect a very long consolidation and pullback, and then we're going to head higher. We actually hit 103, I think it was 82. I think I was off by 51 cents. And that was a call that I made many years before we actually hit that target. And I expected a multi-year target. Now, right now, my view is that we're in a very large fourth wave corrective structure. And as long as that blue box below market price holds, and I'm expecting us to head down to that blue box, as long as that blue box holds, my expectation is we are going to see a multi-year rally in the dollar. Now, some people say that, Trump and the general government would like to see a strong dollar. And the other side of the argument is, well, you only see a strong dollar when during deflation. Personally, I think they're both wrong. I think the dollar is just going to do what it's going to do. And I try not to take imperfect definitions that are brought about through the completely imperfect science of economics. And yes, I was an economics major in college too. I know it well. But economics is an absolutely imperfect science, so much so that most people don't even realize. One of the godfathers of the modern economic theories of fundamental analysis actually was asked, back in 2010. You may know the name Fama, and you may know his theories, but I'm not going to go into the detail on that. But they asked Fama in the New Yorker in 2010, what his thoughts are on his macroeconomic and microeconomic theories are. And he says, well, he doesn't bother anymore. It doesn't work. I mean, the godfather of some of the modern economic theories that we follow today, and which is still taught in college as the basis behind how most people follow the markets, actually came out and said it doesn't work. Now, when all the economists were asked about this, the general answer is, as to why it's still taught in college as the basis and why everybody still follows it, the economists mostly say because we don't have anything better. take it for what it's worth, but I no longer utilize economics. I look at economic theories as ivory tower theories that do not have application in the real world if your goal is success in the stock market. It does not apply. And many have followed suit in discussing this. I mean, Mendelbrot has come out and said that there's no need to use economics when we have the fractal theories that we now have, and so on and so forth. So, I no longer utilize economics when I deal with markets. So whether it's deflation, whether it's a stronger dollar, for me, it's as simple as math. As long as that support box holds, my expectation is for a major multi-year rally to finish off a very long-term bull market in the dollar.
There's a lot of great knowledge in there that you're sharing with us. I do want to go ahead and mention to everyone, that's the charts that we're going to cover today. If you have questions, if you want to jump into the Market Pinball Wizard, where Avi's entire team can help you, right? They've covered so many stocks, so many indexes. You're constantly putting out additional charts and information and continuously staying in contact with everybody there. I'm gonna go ahead and have the link dropped in the chat. And if you're watching the replay, you can also click the link below the video. And I know we want to get into some Q&A here, but I wanted to make sure that I mentioned that as well. The Market Pinball Wizard can be your newest investing group. So give me 1 second. I'm just going to drop it. There you go. All right. So let's jump into some Q&A. I know you asked for Bitcoin. Obviously, crypto, you can go into the Market Pinball Wizard. Also, if you haven't already, follow Avi Gilbert on Seeking Alpha. You also have your author profile that is there outside of the service, where you drop gems of information as well. So first question for you, Avi, is there any time frame that the Elliott wave theory does not work on?
As I said, the market is fractal in nature, which means it's self-similar at all, underlining all, wave degrees. So, you can trade a tick chart in the same way you can trade a monthly chart. It's up to you as to your application. Tick chart will be moving a lot faster than the monthly chart, but it really is all up to your application. If you're able to handle it, feel free to trade the tick chart. Mostly, I like focusing more. I use an 8-minute chart, and I'll use a 60-minute chart. So that's really what I like to focus on.
Yeah, ticks are intense. Here's a question from Lou. What resources can you recommend for getting acquainted with Elliott waves and Fibonacci trading?
The Bible of Elliott Wave is the Elliott Wave Principle, written by Bob Prechter and Frost. So it's written by Prechter and Frost, A.J. Frost. And a book that I cannot more strongly recommend is a book called The Socionomic Theory of Finance. It is a 600 some odd page book. I know that sounds like a very large book, but I will tell you that the first 3 chapters alone are worth the price of the whole book. And I will also tell you that it will open your eyes as to how markets really work. It will, it goes back to, for those of you that have seen the movie The Matrix, do you want to take the blue pill? You want to take the red pill? You take one pill and you'll just go back to seeing the markets as you want to see them, the way you've always been taught. If you take the other pill, it will forever change the way you see markets. And reading the socionomic theory of finance is that pill that will forever change the way you look at markets. So those are the 2 books I would highly recommend.
Thank you. So we have quite a few people are asking the question of, how do you determine on the charts where the first wave starts?
It's a very good question. You really have to, what we do is if I'm going to be looking at a brand new chart, first I want to see if the smaller degree has anything of interest to me. And if it does, then I'll start zooming out. I'll go back to the monthly chart. And then I'll look to where are we in the larger degree, and I'll refine it all the way down to the 8 minutes, sometimes even a 3 or 5 minute. And when I said before that markets are fractal in nature, self-similar all degree, it means also that in order to come up with a very accurate Elliott wave analysis, all the different time frames have to fit together like pieces of a puzzle. So, when you're going back to monthly charts and then you're starting to drill down to the daily, to the weeklies, and then the dailies, and then the hourlies and the minute charts, everything has to fit in. And that's a lot of work. And that is a lot of work to come up with a high probability chart like that. That takes a lot of time. And that, unfortunately, is a reason why a lot of people who claim to do Elliott wave really are not doing you a service. They're doing you a disservice, because too many people will look at a chart and just throw on, I call them wave slappers. They take letters and numbers and throw it onto a chart based upon their view of the chart and how the chart should be progressing. That's not how you do Elliott wave. There is a significant amount of technical detail work that has to be done to come up with an Elliott wave analysis, an accurate Elliott wave analysis. So that's really how we do it. If we come across a 60-minute chart that looks interesting to us, we then take a step back and we'll look at the monthly chart and see where we are in the bigger time frame, looking at a period of at least 30, 40 years, at least. We like to go back even further, depending if there's more price history, but we like to go back as far as possible.
And that's where it pays to have access to your team, right?
Absolutely.
Have the accuracy there. So another question.
We put out a 100+ year Elliott wave chart on the S&P 500. So yeah, I mean, absolutely.
At the data. I love that. So there's also a question. So Seeking Alpha, obviously we have an international community, people all over the world looking and watching this video, and they're wondering, have you noticed if there is the same predictive effectiveness of Elliott wave theory in other international markets such as India and Europe as there is in the US?
Absolutely. We actually have a service that is run by one of our analysts, Garrett Patton, called World Markets, and he analyzes probably about a dozen different world markets, clearly all over the world. India is one of them, yes.
That here says, your outlook is very scary, which I think a lot of people, rightfully so. Where should we put our retirement money if the market is going to go down?
Oh boy, this is a loaded question. First, I'll have to say, I am probably the only, I should start by saying I started talking to my clients about this back in 2018 to 2020. And I started preparing them for, what I was expecting. And I said, my guesstimation was it was going to be somewhere around the mid-20s that we were probably going to hit that major high. And since that time, I'm probably the only analyst you will ever hear from that prays they're wrong. Because till this day, I pray that I'm wrong. When I look at that large degree chart, I pray that I'm wrong. Because if I am right, the ramifications, not just to people's finances, but to society as a whole, probably are going to be quite significant. And I don't necessarily want me or my children or even my grandchildren to be living through that type of environment. So till this day, I pray that I'm wrong, and I pray that I see something in the charts over the next coming years that tell me I'm wrong. So far, it's only been supporting what I've been seeing. Now, of course, when I was talking to my clients about what I'm seeing, they then said, well, exactly like you're asking, well, how do we protect ourselves? So I said, well, one of the things you have to do is find yourself a safe bank. Well, they said, how do we do that? So, well, that's a very good question. And that comes into having to be able to take apart a financial statement. You have to be able to learn how to take apart financial statements of the banks. So I started looking at that myself. And this was about 4 years ago I started this process. And I started looking at the financial statement of the banks, and I started looking at the bank charts. And I started getting very scared, because the balance sheets were telling me that things were going to get quite ugly. It really is very ugly under the hood of some of these banks, most of these banks, in fact. So I then decided to hire a banking analyst, and together we started going through. There are 5,000 banks in this country, and we started going through as much as we could, and we poured through a significant amount of those balance sheets. And we had certain issues that we knew would be red flags that we came up with. And if we looked, that was the first thing we looked for. We looked for the red flags. If a bank had a red flag, next. Bank had a red flag, next. It took us better part of about a year, year and a half to come up with a list of 15 banks that we thought were solid. That's how long it took us in going through all these banks. So I would strongly urge you to find solid banks. If you know your history, you go back to the Great Depression. In the Great Depression, it was somewhere between 40 to 50% of banks that actually went out of business through the Great Depression. And if you consider the Great Depression really began because of a 3-year bear market, a 3-year market crash. What happens if we go through a much longer period of financial troubles? If you look at the great financial crisis of 2008, that was basically a 1-year market crash, and we had 1-year issues and the havoc that caused. Again, what happens if we go through a more protracted time frame of a bear market? Well, that's what I'm expecting. And then if you look at the Great Depression, 40 to 50% of the banks went out of business. Still meant that 50 to 60% of banks stayed in business. So it's your job to now find what are those banks that look more solid. And I'll be honest with you, it's none of the big banks. In 2007, the big banks had one major issue sitting on their balance sheets, which took them down. Today, we've got 5 major issues sitting on bank balance sheets. Any one of them can take them down in a big way. And there are 5 of them sitting on these bank balance sheets today. So, we actually started a service called saferbankingresearch.com. And in that service, we are going through our research on this. And I got to tell you, we've come up with a methodology. It's free. You could take a look on the free pages of that website, our methodology, and you can utilize that methodology to do due diligence on whatever bank you want. But I would strongly urge people, find a safe bank. Because during the periods of market crashes, you don't want to have your money in the market. You want to take your money out and put it in the safe banks. When the market does bottom, if we look at our monthly chart, you'll see we're going to have multi-year, quote unquote, bull markets within the context of the broader bear market. And you can always reinvest during those times for those multi-year bull markets. But for the most part, you probably want to have your money in safe banks. Will gold save you? Will silver save you? Gold and silver are going to go through their own cycles. They're going through, for example, I'm showing you that gold is now going to be topping out over the next year or so and going into a multi-year correction. Gold is going to have its cycles up and down in its own right. You cannot look at gold as the safe haven most people look to. People look to gold as a safe haven during the great financial crisis. And during that time, gold lost 33% of its value. It came back, but it lost 33% of its value during a period of time where everybody wanted to have it as a safe haven. It was not the safe haven everybody expected. There's too much fallacy out there as to what actually markets do during these periods of time. And you really need to know your market history so that you can know what is truth and what is false into what's being presented to you in much of what's written about markets.
Avi, we're about out of time here at the top of the hour, but I feel like because we're talking about stocks, we're talking about the commodities, we're talking about risk, we're talking about how all this plays together. There's a lot of people here in the chat, and apologies, we're not going to be able to get to everybody's question, but if you want to reach out to Avi on Seeking Alpha through his author profile, he might be able to answer you there. Bonds, the risk-free rate that we've all come to know. The U.S. government does not default on its debt. This is what we all believe. This is what we've seen through history. Does Elliott wave theory work in the bond world? Is that going to be someplace that somebody can go and still get their yield during this next bear market?
We have caught almost every major turn in the bond market for the years that we've been tracking it. So it works exceptionally well. The problem with the bond market is I would love to see a multi-year rally now in the bond market. The problem with that is that if I do see that multi-year rally in the bond market, it is going to set up a bond crash that was much worse than what we've just seen from the all-time highs. So there are going to be periods of time where, yes, you can invest in bonds. There are going to be periods of time that you do not want to be in bonds. And if you're asking me if I believe that there is going to be some form, not full default, but some form of write down of bonds in the future, my answer is I believe the charts are telling us that that's potentially going to happen. If we look back to what happened in 2010 in Europe, and we saw the European debt crisis, and what that did to the European bonds and the rates there, I believe we're going to see the same thing here in the States. I believe we will see double-digit rates. But it's not going to be times where you're really necessarily going to want to jump in and buy your bonds, because it's going to be for a different reason than we're used to. It's going to be what we saw in Europe. It's going to be because many people will begin to distrust the US government's ability to repay its debt. And that is not a time where you necessarily want to be investing in bonds. Once all the dust settles, then yes, you will have an opportunity. But I believe there is going to be big risk in bonds as well.
All right. Avi, one more time for the people watching. They're asking about the two books that you had mentioned. Plug those one more time for me, please.
The first book is the technical book about Elliott wave and how to apply it. And I'm going to warn you, it took me 6 reads before the light bulb went on that one. It is a very difficult read, but it is well worth it if you learn Elliott wave analysis. It's called The Elliott Wave Principle, written by Frost and Prechter. The second book was written by Bob Prechter, who's become a friend through the years. Bob has completely changed the way I view markets, and I strongly encourage anybody who is really interested in learning the truth about markets to read the book. It's called The Socioeconomic Theory of Finance, written by Bob Prechter.
Avi, I can't thank you enough. You came here today and dropped a wealth of knowledge. I know everybody's a little trembling, maybe a little bit about the outlook here, but we know that you have the Market Pinball Wizard, you have the community, you're always doing updates about the charts, keeping people engaged, keeping that constant voice just going, which I think people will definitely need if this comes to fruition, let's be honest. So everyone, I highly encourage you, go check out the Market Pinball Wizard. Avi Gilbert, everyone. Everyone have a great rest of the week, and take care. We'll see you in the next webinar.
Thank you for having me.